Hi, welcome to Market in a Minute. The fireworks display from DC was just incredible. Most incredible fireworks I've ever seen, even if it was on television. And the USA out of the World Cup. I was really starting to enjoy football. I'll probably have to root for that big Viking guy from Norway, I guess. The review of the first half, that's what we want to cover. And then how to handle the volatility we see coming in the second half. So where the opportunities are in the third quarter. Disclosures, I know this is your favorite part, but please read this at your convenience. Review of the first half. So we called this fairly well. Okay, we were looking for a correction, if not a bear market, as we started the new year. We knew there was going to be volatility. We got it. The market fell, the S&P fell from high to low about 9.2%, and the tech space really got hit hard. As we all know, the war with Iran caused oil prices to go up. They went all the way to about $113 per barrel in April, and now they're back to about 68. I guess on Monday they rose a bit, but we've probably hit maybe a short-term low, and we think oil prices could go much lower. So we started this is oil over the last, say, 25 years. Some very large moves here, up and down. And you can see the low's been about $56, $57 before this big spike that we got because of the Iran situation. And you can see after these big spikes, it's come back down to levels that it was lower at than where it started. This one was kind of a very protracted decline, and then here came back down to roughly kind of not where it started, but at the previous peak. But we're thinking the oil prices could come down at least into the 50s. If not, they could potentially come down into the 40s. And what happens is that the oil companies ramp up production, because the prices are so good, and all the oil generating countries do the same thing. They increase production, and then oil prices, you can't just shut off the wells, so oil prices come back down to lower levels. So when the market concluded that Iran was behind us, okay, we were actively buying things, very actively buying things on this big pullback. We've got a lot of good companies in our portfolio. But when the market figured it out, it had a very nice rally. And we've been bulls on small caps, right? So I want to show you that. So here's a Russell 2000, right at the bottom, okay, to the top at the end of the quarter, 25.5% move. That was a really nice move in the overall indexes. And you can see here, the Russell 2000 did very well year to date, held up well, did well. And then gold prices fell, bonds fell. So bonds have not been a good place to invest. But we think the second half actually looks pretty good. The big loser was the Bitcoin. Bitcoin came down quite a bit, over 33% in the first half of the year. We don't think it's over. So the market concluded that things aren't that bad in Iran, that potentially oil prices have peaked out, inflation is probably going to come down, interest rates will probably come down at some point. But the market got comfortable with it, had a nice rally. What we've seen in technology has been quite remarkable. We saw the semiconductor stocks really outperform in a huge way. We think what's happening is that the users of semiconductor stocks are buying semiconductors, or they're ordering semiconductors as much as they possibly can to jump the line. We don't, and then the prices of memory devices have been going through the roof. So memory, it's a commodity, it's going through the roof. There's a handful of large manufacturers. They're going to get aggressive on building new capacity. It's just like the price of oil. When the price of oil spikes, it comes back down. when the price of semiconductor stocks, which hardly ever does happen, they'll come back down as supply and demand come into balance. So semiconductor stocks as a percent of the S&P 500 are now 19.7% of the S&P. So the semiconductor companies, we've had some really good ones there, but they've broadly taken over a large part of the technology space. The mega cap stocks have lagged quite a bit, and then the software stocks really have performed poorly. We think they hit a bottom. However, there's a cloud over that particular sector. So to give you some context, so semiconductor stocks at 19.7% of the S&P 500. Well, during the dot-com phase, same thing was happening. They got to about only 8% of the S&P 500. So we're multiples over what they were back in the other large bubble we had. So generally, semiconductor companies are not a big part of the overall S&P 500. So this is extremely unusual. It's not sustainable. It's kind of insane. But generally, they're about 2 to 5% of the overall S&P 500. So there's a guy named Tom Kurlak. There's a little side story for you. Tom Kurlak worked at Merrill Lynch. He's a semiconductor analyst. I met Tom in his office once, and he'd come by periodically to visit where I was working just to give an update. So at Merrill Lynch, Tom used what was called the book-to-bill ratio. So this is the order trends divided by the revenues. And when that order trend got up to a certain level versus the actual revenues, so orders per revenues, when that got up to about 1.5 or 1.2, whatever it was back then, that's when he would put a sell rating on the entire group. And what happens is that the semiconductor stocks themselves continue to look pretty good because the revenues are still coming in fairly nicely. But roughly, maybe there's 2 quarters of still solid fundamentals, and the stocks will start to react negatively as the order trends start to slow down, start to be a much smaller portion of the revenues. So the market anticipates that the semiconductor order trends will slow down, and it's cyclical, so they start to decline. I know that's a long explanation of how this works, but we believe a lot of the users that are ordering these semiconductors are probably double ordering or triple ordering, and it's driving up the prices of everything. So in the first half, commodities fell, generally speaking. We've had silver fall 15%, gold fall 7%, Bitcoin down 33%. So you can see that some of this hot money, remember, gold did real well, silver did well. I had a lot of people call me about silver, and I said, don't touch it. I wouldn't touch Bitcoin either. But anyhow, a lot of people want to play these fast money trends, and they turn out to be losers, generally speaking. But we think a lot of the hot money has gone into semiconductors and has driven some of those prices up beyond what is a sustainable level. So copper's gone up, so that's kind of odd. So I think what's happening there is the market is signaling, okay, inflation might be peaking, so why would I want to own gold or silver or Bitcoin? So inflation might be peaking. We got a new Fed chairman that's going to fight inflation, but the economy's still good. So copper prices, rose, which is kind of a contrary trend a little bit with everything else going down and it going up. So maybe the economy is probably better than what most people think, and maybe the market's starting to anticipate, because of the lower oil prices, gas prices, lower inflation, that interest rates will come down and kick off another cycle, another leg to this economic growth we've been seeing. So maybe it's just not all data centers after all. Private credit was front and center, and frankly, I think it's just the naivety of the retail investor. not knowing that they could get locked up in these private funds. So when you think about you're entering a private fund, the assets are private. There's no liquidity in these private positions. So if they have to sell them, maybe it hurts the other investors that want to stay in. So it's up to the managers what they do there, only allowing 5% of redemptions uh, per quarter. That's pretty lenient personally. A lot of funds, hedge funds just don't make any sort of redemptions if they get more than what the fund can handle if they don't have the liquidity. So I think we do our own little check on real estate. We think real estate prices are beginning to fall. Some of the markets I look at are down 5 to 10%, and I think there's no buyers. So we're in a tough period in terms of seasonality, and oil prices have been part of the problem. I think it's stalled the market. And in the employment area, AI has stalled the employment growth. So there's a little bit of a hiring freeze, so people aren't moving around very much either. So I think prices maybe are going to come down, and put the supply demand more in balance. So now there's probably more sellers than buyers. So this inflated real estate we've been seeing in the residential area is probably going to come down to find where that market clearing price is on homes. That's not a good thing to happen, but I think it's necessary to get the turnover rate of housing to kick in, and some of those housing plays that we've been watching for a while, like Floor and Decor and Lowe's, will probably start acting better. Outlook for the second half. So we expect a kind of another play of the first half. We would expect some more volatility. So the volatility we got in the first half will probably happen again in this quarter. We think that there's a good shot that we're going to see a correction occur. I think the market's got AI fatigue, that it's getting overexposed in people's portfolios. And if oil can contain itself and actually even go lower, I think that'll spur people starting to look at other sectors. So we expect volatility this quarter. We think that the bond market has been discounting another rate increase, which could happen in July. We think if that happens, that's big. It's a big problem. We don't think it should happen. So inflation is at a peak and coming down. So we don't think that the Fed should raise rates. If anything, they should be thinking about cutting rates. We have the federal funds rate now about 0.5% below what the 2-year Treasury is. You usually see all the way around. So the 2-year Treasury is telling the Fed it should be cutting rates. So what generally kills a cycle is the Federal Reserve. So we don't see that happening at this point. We think that new Fed Chairman Walsh will keep things under control. Will lower rates when they're needed, and there's no rush. There's no reason to raise rates at this point. So we don't think he's going to kill off this cycle, but the cycle is going to become more volatile as money is being shifted around more. Maybe it doesn't shift from one sector of the market to another. Maybe it comes out of one sector and then later goes into another sector of the markets, just to torment us even more. So one major systemic risk, something to think about. Okay, we're seeing a very similar sort of cycle, maybe larger and longer than what we did in the dot-com phase. But as the dot-com phase ended, when that build out of the dot-com stopped, and it caused a recession in the overall economy, and it caused a major bear market that lasted multiple years, and from high to low, the Nasdaq dropped 80%. So that's the big systemic risk issue. We want this to go smoothly, but it may not. So that risk is out there, and it's worth monitoring. The mid-year elections, we thought this was going to be a concern, but the Democrats probably gone way too far on the left scale, maybe even off the scale completely with the candidates that they put forward. So I don't know if the market's going to discount like it usually does the risk of the inflation of the election. coming in November. So maybe we don't have to deal with that. So earnings momentum has been very strong, and it's coming out of the semiconductor stocks and the commodity semiconductor stocks in particular. So that's what's been driving the earnings momentum of the overall market. So this is not a sustainable trend. The market's not going to pay up for these type of earnings. So we're probably going to see valuations come down a little bit as we go through the year. Likely to see a large rotation as the momentum maybe slows in technology. When that occurs, I don't know. But we do think that if gas prices can drop, similar to what oil prices did, we're going to see it kick off sooner rather than later. So we're going to see that rotation in the other sectors of the overall market when the gas prices start to catch up with the oil prices. So leverage for buying stocks is at an all-time high. So we're at a record high in terms of margin debt. And so the hot money's moved around. So it's moved from cryptocurrency to semiconductors. So there's a lot of hot money that's invested in the stock market. I want to show you this chart. This is a really cool chart, margin debt. Okay, so here the blue line is the S&P 500 divided by this currency in circulation. So it adjusts for the amount of currency in the overall economy. So that's really important. So as stock prices go up, currency probably also goes up. The circulation of currency goes up. And so this is a nice way of looking at what the stock market has been doing. So basically you want to buy when the ratios are low and sell when the ratios are high, right? So the red line is the FINRA margin balance. So this is margin debt divided by the currency in circulation. Again, it kind of adjusts things. So it adjusts for the amount of the size of the economy in general over time. So you can see now we are on that measurement. We are at an all-time high in terms of margin debt. And the stock market is at an all-time high as well in terms of its valuation divided by the currency in circulation. So these are really concerning sort of trends. These are not sustainable. So it will come down over time. And then the US dollar per yen. The US dollar has been very strong versus the yen. So over the last 5 years, so the dollar's gone up roughly 46% versus the yen, which means the yen's been really weak to the point that they're going to have to intervene again. And when the Japanese bank intervenes, it usually causes major disruption in their overall markets, but also disruption in our markets. So consider this another, I'd say, minor systemic risk issue. Now, we had this issue similar to this back in 1998. It's called the Asian currency crisis. And we could see something similar. Maybe not as bad, but something similar. So these two charts are rather concerning in our opinion. And I think it just sets the backdrop of, okay, we've got a lot of debt, a lot of issues in the overall markets. We need technology to cool off a little bit and get some rotation in the overall markets. That would be very helpful and not destroy the overall bull move that we've been seeing. It kind of sets the market up into a much higher risk profile than I think most investors understand. And if the market decides to get defensive, there's a lot of downside potential in the overall stock market. So conclusion, the bond market should be better as inflation drops and the pressure comes off the Fed, okay? The Fed would like to be more accommodative, but it can't. It would like to see inflation drop. So if oil prices stay where they are, as I mentioned, gas prices fall, inflation falls, it allows the Fed to keep interest rates where they are or bring them lower. So we think the bond market will be in much better shape as we go into the second half of the year. That's generally a good thing for the stock market. So we're also thinking we're going to see some rotation. It's odd how we do get some rotation at times when technology stocks get way ahead of themselves, and then the overall market catches up. And funny thing, it does happen, in my opinion, frequently in the third quarter. So we could see that happen this quarter. So there is a massive amount of liquidity, debt, leverage, um, lack of being able to access your money at times for some retail investors. And then because of all this leverage and high valuations, we think the market is just naturally going to be more volatile. And how that volatility moves around will be quite interesting to see how it plays out. So we think it's important to stick to a discipline, buy attractively valued stocks, not things that have run too much. So catch them early, where the fundamentals are just starting to improve, not 6 months or 6 quarters after the fundamentals have already occurred. So we think that there are some good quality companies still in the technology space, and more will come around if we do get that correction. But as example, we've been watching Qualcomm. The fundamentals, in our opinion, have not quite improved there yet. The stocks popped up, kind of caught us off guard, but that's one we're looking at. Also, Hewlett Packard Enterprises, we think that's changing. So we think that there's potential in that stock as well. And when the tech group comes down, there'll be more stocks that will probably hit our list. Healthcare is full of potential great stocks. So we've been riding the Lilly trade for a while. That's been really nice. We think Lilly is a core holding. That's got more upside. They've got just incredible management, lots of things in their pipeline. Would I buy that stock today? Nah, probably not. Would I hold it? Absolutely. I would focus on, the biotechnology area. These large pharma companies have to buy these biotechnology companies to fill their pipelines. And I think that the two that kind of stand out to us, high quality companies, Viking Therapeutics, I mentioned this 2 weeks ago. You see how that stock's improving. We met with management 2 weeks ago. I think that there's a good shot that they could be bought out sometime in the next 6 to 8 months, something like that, at a much higher price than what they are currently. The other one is Grail. Grail has the cancer test. That test is highly likely to get approved. Of course, if it doesn't, it's probably a zero, but highly likely that'll get approved, and that stock will go much higher. The beneficiaries of lower oil prices, gasoline prices, a pickup in consumer demand, clearly in the retailers. A lot of those retailers are beat up, and as interest rates drops, it'll get some of those companies going on a cyclical basis. So Floor & Decor, they've got beautiful store openings. On Holdings is going to grow really nicely as well. That's the tennis shoe company that I like a lot. Lowe's, like that one as well. Restaurants. Now we think that as gasoline prices fall, it's just a natural thing for restaurants to do better. Same way with travel, like Carnival Cruise Lines, transportation. UPS has a gigantic yield on it. UPS will be a big beneficiary of a drop in gasoline prices. Financial services, the banks have been acting better. I think this is kind of a core area to look in for buy ideas. Capital One's one that we like a lot, and the industrial space having a harder time finding things here. Some of the AI plays have already played out in a huge way. Caterpillar tractor is probably way overvalued at this point. So got to be selective in that part of the markets. But there's a lot of things to take advantage of. I would keep some powder dry and think about a nice correction to occur. I don't think a bear market is likely coming this year. It'll probably come next year or maybe the year after the Fed has to maybe start to raise rates at some point. But I think what's in front of us is the Fed's going to be somewhat accommodative. So there might be another leg up in this overall market, but it's not going to be an easy leg up. It's going to be one that's filled with volatility, and it'll probably scare a lot of investors. There's a lot of hot money moving around, and it could be very disruptive. Another thing to think about is you can get really attractive yields. So we have a tactical income model that I manage at PVG. So it's got about a 10% yield on it. That's just about as high as I've seen in a long time. There's many undervalued bond slash equity type of securities out there that have very high yields on them, where we believe that those yields are sustainable. So we don't think the dividends are going to get cut. So that if you compound at 10% a year, that's probably faster than what the market's going to compound at. Maybe quite a bit higher than what the market's going to compound at. But that is a really nice way to compound your money over time and not take a lot of risk. So income investors, there's some really good opportunities out there as well. Please hit like, subscribe, come to my channel, Patrick Adams CFA. Actually, come to my website, Patrick Adams CFA, or come over to PVG, see what we got going on there. Lots of cool stuff, and you can see the strategies we manage, and you can always communicate with us off the PVG site as well. Again, hit like. Take care. Bye.